going to talk about the most hated investment strategy, and it's a strategy that is rarely ever used by the investment industry, even though it's one of the golden rules of investing. We're going to talk about diversification. When we diversify, we think, well, don't put all your eggs in one basket. So I'm going to walk through this and have us understand why it is a hated strategy by the industry and by investors. I was having a conversation with a financial advisor, and I said, hey, as a financial advisor, what do you think your job is? And he says, well, make people money. And I said, yeah, no, it's actually to keep your job. So what I like to explain to people is, let's say that you were going to talk about what the market did on any given day. What's the market doing? And ask a person, what is the market? They would tell you what? The Dow, the S&P 500. So for most people, the market, as we call it, is going to be the Dow or the S&P 500, big U.S. companies. Now, if you run a portfolio for somebody, this is me talking to this financial advisor, and you have this fund or this portfolio that you run, and the market is up and your fund is up, is your job safe? And he goes, yeah, absolutely, my job is safe. I said, good. Let's say that the market is down and your fund is down. Is your job safe? And he goes, well, yeah, because markets go up and they go down. Then I said, what happens if the market is way up and your portfolio is only up a little bit? Job safe? No, you're an idiot. The market's way up and you're not up with it. So let's walk through this. When I diversify back through history, this is using 30 years of data. You'll see these various asset categories, and all of these lines are different areas of the market that I might be investing in. And this is what is called the style box. So I'll have small companies, and I will have value companies and growth companies and large companies. And when I diversify, what am I doing? I'm holding a little bit of U.S. small value, U.S. large value, U.S. small growth companies, U.S. large growth companies, and I'm going to do the same thing in the international markets, and that's me diversifying the portfolio. Now, I'm also going to use bonds in the portfolio as well, so that helps mitigate some of the risk of stock markets, because markets go up and they go down. And you notice when markets went way down here, how bonds held their own, and that's the reason we have bonds in the portfolio. It offsets some of that risk. Now, let's look at that same period in time and see what actually happened. We see that fixed income investments like treasury bills, like CDs, we see that had a very, very low return over that period of time, which is what we expect. We don't own them for lots of return. And then we see that we have U.S. small company value stocks, which is that asset category right there, where we expect the most return, actually having the most return over that period of time. So no surprises over 30 years. Let's take a look, though, at what happened from 1994 through 2023 with a diversified portfolio. You notice something different. It's in the middle of the pack, which is why we diversify. You're not going to have the highest return, but you're also not going to be in the tank as far as return goes over that period of time. Now what I want you to do is look at this. Look at large U.S. stocks from year 1995 through 99. These are the tech bubble years. And what I want you to notice right here is that during that period of time, large U.S. stocks were doing super, super well. So that's that area of the market where we don't expect the highest. Remember, we expect higher return here. We see large U.S. stocks doing super, super well. And that's why we own it, because sometimes that can happen. Now, over that same period of time, what we notice down here is international small value stocks, which is international small value where we would expect more return, actually had the lowest return over that period of time. And an investor would be looking at that and go, why do I bother owning that junk? I mean, look at it. It's doing nothing but dragging my portfolio down. And if I look at my evenly divided portfolio, large U.S. stocks, which was up here, my evenly divided, my diversified portfolio doesn't look near as good. And that's where an investment manager might get fired because they look like an idiot. You see what I mean? Now, let's take a look at the period going forward, however, from 2000 through 2004. This is the next 5-year period. And what we notice is that area of the market that was doing so well, large U.S. companies, which is, remember, it's the market for most investors, actually had a terrible performance. They actually lost money over that period of time. And then over that same period of time, we had an evenly divided portfolio doing much, much better. Now all of a sudden diversification looks brilliant. So you see that as an investor, if you didn't pay attention to any other area of the market, all you paid attention to was the market, the S&P 500, you wouldn't have even realized that happened. So a lot of times investment managers don't do that. They don't actually point out those types of things because they'll probably lose their job. But diversification saved the investor during that period of time, and you can see that. And that's why we do it. Now, going back from 2014, let's take a look at the last 10 years ending in 2023. And what I want you to notice is here's diversification again. You got all these different areas of the market. Now, it'd be great if we could just say, hey, let's just put everything in the asset category that's going to be the top thing going forward. Let's just do that. That would be wonderful if we could do that, but we know that we can't do that. But let me show you what's happening recently and how similar it is to the late 90s. Large U.S. stocks, again, the top area of the market over the past 10 years. Now, these areas that are lagging down here are some of these international, for example, over the last 10 years. So a lot of investors look at that and go, oh gosh, why do we own that? Now we already know why we own that, because it can turn on a dime and it can change in a heartbeat going forward. If we could figure out what was going to do best going forward, we would be able to, by definition, market time, and we know that we can't do that. But I want you to see something else that's super, super interesting. When we look at, let's say, a CD, and that CD pays a 5% interest rate, we know that we are paying $100 for the right to receive $5 in interest. We all get that. Stocks are very similar. Matter of fact, Warren Buffett actually said that stocks are bonds in disguise one time when he was asked about this. And he was talking about what was called the earnings yield concept. So what he's saying is that if I buy a stock and I pay $10 for a stock, let's say, and it has $1 of earnings attached to it, that's my price right there that I pay, $10, and it's got $1 of earnings. And let's say I get $1 of earnings this year, next year, next year, next year, on into infinity. Now, we really want to try to grow earnings, but let's just say the earnings stay the same. My earnings yield, just like I had $5 of interest for every 100 that I paid here, my earnings yield would be $1 of earnings for every $10 I paid, which equals what? 10% for those of you that like math, like me. So if we look at that and go, oh, there's my earnings yield. So the lower that number, the price right there, the higher the earnings yield. Because if you think about it, if my number right there was 20, what would be my earnings yield? 1 divided by 20 equals 5%. So you get that. The lower that number, the higher the earnings yield versus the other way around. Now, what's going on right now as we speak? Right now as we speak, large U.S. stocks are selling, as measured by the S&P 500, are selling for $23.01. The earnings yield, that means, is $4.3%. That's my earnings yield. If I look at the areas of the market that have been out of favor recently, and we're looking right here at international large value stocks, international large value, which would be that area right there. We see the S&P, is that right? That area right there? Over here, this area of the market is literally only selling for $9.91. That gives us an earnings yield which is much higher. As an investor, it would be a really bad move probably to go and say, hey, I think what I'm going to do is I'm just going to sell all of this because it hasn't done as well recently and buy more of this, because what are we looking at? It's going, hey, let's move all our money out of that thing that has a higher earnings yield and move it all into the thing with a lower earnings yield. It doesn't make any sense when you look at it that way, but it's just a different way of looking at diversification. As one academic once said, diversification is your friend. It helps reduce the overall risk of the portfolio, and it can help increase the expected return, but it really helps protect investors from themselves. So even though it may be the most hated investing strategy out there, it really should be one of your best friends.